Welcome back to the Deep Dive. Today we are focusing on a company that has truly, well, mastered the art of the consumer staple niche. Church Dwight Co, Inc., ticker symbol CHD. If you've ever bought Arm & Hammer, the iconic baking soda brand, or perhaps maybe a more recent star like a Hero Acne Patch or TheraBreath mouthwash, then you're familiar with their work.
Yeah, they are fascinating because they don't really operate like the behemoths of the industry, right? They're not trying to compete head to head with Procter & Gamble across like 100 different categories.
Right.
Instead, they position themselves as a master of acquiring and scaling these smaller, high growth, high moat specialty brands. They're really a masterclass in portfolio optimization, and frankly, that's why the market seems to love them.
Okay, let's unpack this then, because our mission today is, well, it's complex. It centers on a pretty significant contradiction, I think. We're analyzing a deep investment research report on CHD, and it praises the company's fundamental excellence, particularly its proven best-in-class M&A strategy.
Right, that flywheel effect.
Exactly. Yet the stock itself carries this persistent and utterly significant valuation premium. It's like the great company that's perhaps trading at a price demanding absolute perfection.
That is absolutely the central tension.
Yeah.
The core thesis of this report, it lands on a neutral stance precisely because of that high price tag.
Right.
The market appears to have fully priced in not just their current success, but, well, nearly all their future M&A triumphs, too, potentially overlooking some pretty serious headwinds.
Yes.
Well, we're talking about a slowing consumer economy impacting demand, that's hitting everyone.
Sure.
Then there's intense structural competition from private labels hitting their core value brands.
Right, the Arm & Hammer stuff.
Exactly. And critically, there's an upcoming CEO transition. That always adds a layer of uncertainty.
So for you, the listener who's trying to understand the risk versus reward here, what's the clear guidance from this analysis? What does the company need to do to justify that premium?
Well, it means we have to watch for external events or internal performance shifts. The report suggests two key trigger points for reevaluation.
Okay. What are they?
First, does the stock experience a significant valuation pullback? Meaning, does the multiple compress down towards its peers, making it, an undeniable value proposition? Or second, and this one is all on the management, do they manage a sustained period of gross margin expansion?
The margins.
Yeah. That sustained margin growth would signal that they've finally and successfully eased those competitive and inflationary pressures that have been, frankly, squeezing profitability.
Right.
Until one of those two factors materializes, the risk profile, while it's balanced by the quality of the business, it's definitely tilted toward risk because that enormous valuation premium leaves basically zero margin for error.
Okay, let's start with why the market built that premium in the first place. Their strategy. The research calls it the Evergreen Model. That sounds incredibly reliable, but almost comforting.
It does, yeah.
How do they codify their algorithm for long-term value creation? What is this model?
It's really defined by a highly disciplined set of long-term targets. It's like a formula they aim to hit year after year consistently.
Okay.
The Evergreen Model is basically CHD's commitment to achieving 3% annual organic revenue growth.
Just 3%.
Yeah, 3% organic. That's the baseline, right? The engine that kind of never stops. It's the result of continuous innovation and market share defense in their existing brands.
Okay, so if the engine is chugging along at 3% revenue growth, the market demands to know, how do they consistently bridge that, 5% gap to get up to 8% EPS growth? That sounds like where the magic happens.
That's exactly right. The mechanism is really a combination of operating leverage and that M&A flywheel we mentioned.
Explain operating leverage quickly.
Sure. Operating leverage just means their costs grow slower than their revenues as they scale, so that improves margins over time. But the real driver, the thing that gets them from 3% to 8%, is the accretive M&A.
Accretive meaning?
Meaning it adds more to earnings per share growth than it does to revenue growth. So they buy a smaller, fast-growing company, they plug it into their global distribution system, strip out overlapping costs, and boom, that deal adds significantly more to EPS than it does to the top-line revenue.
Got it.
This dual-pronged approach, organic growth plus smart M&A, that's the company's algorithm for long-term value creation, and it's all funded by the stable cash flows of their big legacy brands.
Right. So to understand the execution, we really have to break down their operations into the three core segments. Let's focus first on the giant. consumer domestic. This accounts for, what, a whopping 77% of total company sales?
Yeah, it's huge.
It's their core, but it sounds like it's also their biggest challenge right now.
It is. This is the foundational segment, absolutely. It houses nearly all of their cash cow power brands, Arm& Hammer, Trojan, OxyClean, you name it. But the U.S. market is mature, very mature, and competition is fierce, especially in that value segment where Arm & Hammer plays hard.
And the recent data shows that.
Yeah. Oh, yeah. The recent Q2 2025 data really underlines these structural challenges. This segment actually saw an organic sales decline of 1.0%.
Wow, a decline in their core domestic market, given that 3% overall target.
Yep.
That's a significant signal, isn't it?
It really is.
Where exactly did they feel that softness most acutely?
Well, we saw two main areas under pressure, according to the report. First, the lingering effects of the post-pandemic slump in the vitamin category, specifically VitaFusion gummies.
Right. Everyone's stocked up.
Exactly. That whole category is still kind of readjusting after the huge demand boom in 2020 and 2021. Second, they saw softness in certain legacy household brands like OxyClean stain removers. They're facing immediate pressure from both competitors and, crucially, private labels.
That must be a but.
But yeah, this is where the M&A strategy is so critical. That 1.0% domestic decline was partially offset by very strong volume-driven performance from the recently acquired brands that live in the segment, namely Hero and TheraBreath.
So the new acquisitions are propping up the core.
In a way, yeah. They are the essential shock absorbers right now in the domestic market.
Great. That leads us perfectly to the second segment then, the Consumer International Division. That's about 18% of sales. If domestic is the stable, albeit currently shrinking, foundation, international is explicitly designated as the primary organic growth engine. Does the data confirm they're actually executing on that mandate?
It absolutely does. And this is really where CHD validates the whole Evergreen Model concept. In Q2 2025, International delivered a really robust 4.8% organic sales growth.
Nice.
They are consistently hitting or even exceeding their targets here. This growth is validation because it proves they can take an acquired U.S. success story, like Hero or TheraBreath, and scale it globally using their established distribution network. And often they face less competition internationally than they do domestically.
Can you give us a concrete example of that global scaling in action, something specific?
Yeah, sure. Think about the massive global rollouts of their recent acquisitions. They've successfully launched Hero acne patches across Europe, Canada, and Australia now. Okay.
They've done the same thing with TheraBreath, pushing it into Canada and other global markets. So this segment isn't just about selling more of their older legacy products overseas. It's demonstrating the repeatable, successful execution of the M&A playbook on a global stage. And that's crucial for proving the value of the whole platform, you know.
Right. Proving the premium isn't just hype.
Exactly.
Okay, finally, we have the smallest piece, the Specialty Products Division, or SPD. That's just 5% of sales. What's the story here? Is it growing too?
No, actually. The SPD focuses on industrial and agricultural specialty chemicals, primarily centered around sodium bicarbonate, baking soda for industrial uses.
Yeah.
Here, the narrative is not really one of growth, but more of disciplined portfolio management and focus.
Meaning?
Well, the Q2 2025 sales decline you see in this division actually reflects the 2024 divestiture of the Megalac animal nutrition business. They sold it off.
So this is a strategic subtraction. They're consciously choosing to shrink this segment to optimize the overall portfolio. Makes sense. Precisely. They are pruning lower margin, non-core businesses. This is a very clear, deliberate signal from management. They are reallocating capital and, just as importantly, management focus away from these commodity industrial segments and towards the higher growth, higher margin consumer goods segments.
Right.
It sharpens the overall company profile, frees up capital potentially for M&A. It shows a commitment to that margin expansion goal we talked about, even if it means sacrificing a bit of top-line sales in the short term for, 5% of the business.
Okay, so the company's resilience really comes down to its brands. The research highlights that a full 75% of sales and profits come from this concentrated portfolio of power brands. Now, concentration is sometimes flagged as a risk, but here it also underscores the tremendous importance of their brand equity, right?
It's definitely a double-edged sword, yeah. But the strength of that 75% is pretty undeniable. Their portfolio is, almost perfectly balanced, creating the self-funding ecosystem. Well, on one side, you have the core stalwarts. These are the legacy brands like Arm & Hammer, OxyClean, Trojan. These are the giants, the cash cows, that provide the massive, consistent, high-velocity cash flows.
Right.
And that cash is the literal fuel for the M&A engine, the flywheel we keep mentioning.
And Arm& Hammer itself is just a masterclass in keeping a, what, century-old low-cost commodity product relevant and profitable? It's definitely not just a yellow box of baking soda anymore.
No, they treat it almost like a premium product through constant strategic innovation. It's quite impressive. Take laundry detergent, for example. They don't just offer one single product.
No.
They employ this highly effective good, better, best tiered strategy.
Explain that.
So the good is the basic low-cost value option. It's highly competitive on price, directly taking on store brands.
Okay.
The better options include value-added features, like maybe integrating OxiClean stain fighters.
Right.
And the best tiers incorporate new high-tech features, like their deep clean technology, which justifies a higher price point and attracts a different consumer.
And what has this innovation strategy actually achieved for them in a tough category like laundry?
It's been incredibly successful, actually, in both defending and gaining share. This tiered strategy has pushed Arm & Hammer to an all-time high market share of 14.8% in the U.S. laundry category.
Wow, nearly 15%. That's huge against Tide and the others.
It is. This constant incremental innovation is the company's primary line of defense, really, ensuring their value offerings remain compelling against the biggest threat out there: private label brands.
Okay, so that continuous cash flow from the stalwarts like Arm & Hammer allows them to go hunting for the acquired stars where the real growth is found.
Exactly.
And the success stories of Hero and TheraBreath are just phenomenal, aren't they?
They truly are. They're basically the poster children for the current M&A playbook. Hero, which focuses on specialty acne treatment like those little patches.
My kids use those.
Right. They rapidly dominated that niche and became the #1 brand in the category with just a dominant 22% market share. They identified a trend acne patches, bought the leader, and then used their muscle to scale it globally. Textbook.
And TheraBreath seems perhaps even more impressive, specifically because it's in highly competitive oral care space, which is absolutely ruled by giants like Colgate and Listerine.
It's a remarkable story of market disruption, yeah. In just 5 years, CHD took TheraBreath's market share from a tiny 4% up to a massive 21%.
Incredible.
It is now the #2 mouthwash brand overall, and crucially, the #1 alcohol-free mouthwash brand. These are not just small incremental gains. These are market-shifting successes delivered through disciplined integration and, frankly, very effective marketing muscle.
What's fascinating, though, and important for the listener to understand, is that this, seemingly flawless M&A playbook wasn't invented overnight. It was actually forged in failure, wasn't it? CHD had some very high-profile missteps that cost them dearly.
They did, absolutely. And management, to their credit, has been pretty transparent about the lessons learned from those. The two main painful lessons came back in 2022.
What were they?
First, there was the pretty significant write-off of the flawless hair removal device business. Remember those?
Vaguely, yeah. Didn't work out.
Didn't work out.
Right.
And second, significant impairment charges, which basically means they recognized that the assets were worth less than they thought against the VitaFusion gummy vitamin business. That was primarily due to that sudden post-COVID slump in demand we talked about earlier.
So the strategic pivot that came after was a necessary but obviously expensive correction. What did they actually learn from those write-offs that redefined their acquisition criteria going forward?
Well, the lesson was pretty simple, actually, and quite fundamental. Move away from trendy consumer devices like Flawless, which tend to be short cycle, require heavy capital expenditure, and often face quick obsolescence.
Right.
And instead pivot entirely toward asset-light, fast-moving consumables with predictable recurring revenue streams.
Makes sense. Devices are one-and-done purchases, maybe. But mouthwash and acne patches require constant repurchase.
Exactly. The 2022 annual report explicitly cemented this refined strategy. They basically stated they would stick to acquiring fast-moving consumables. This really de-risks the entire M&A model quite significantly.
And we see this refined, battle-tested playbook in action with their latest move, right? The acquisition of Touchland?
We do. The May 2025 acquisition of Touchland, which is a premium hand sanitizer brand. You know, the ones in the cool, colorful spray bottles.
Yeah, I've seen those. Premiums are right.
Exactly. That was a $700 million wager, plus a potential earn-out based on performance.
Wow, $700 million for hand sanitizer.
Well, it aligns perfectly with the refined strategy, right? It's asset light, it's a recurring consumable, and it's high margin. Management is incredibly bullish on it, stating they are confident they can triple the brand's business over time. primarily by using that high-growth international segment for global scaling, just like they did successfully with Hero and TheraBreath. This deal, Touchland, is really the market's current justification or test case for that sky-high 42x PE premium. They need it to work.
Okay, let's pull back a bit now and look at the overall battlefield. When we compare Church & Dwight with its, $6.1 billion in annual revenue, it's clear they are a niche player. They're dwarfed by multinational behemoths like Procter & Gamble, who are north of $84 billion.
Oh yeah, it's not even close in terms of scale.
So how does a company this size not just get crushed by the marketing spend and shelf space power of those giants?
Well, they win by essentially staying in their lane. Their success is built on avoiding that direct, head-on, multi-category competition. They don't want to fight P&G everywhere.
Smart.
Instead, they focus ruthlessly on being number one or number two in very specific defensible niche categories. Places where brand loyalty or perceived quality or maybe a specific therapeutic need matters most to the consumer. That's their strategic moat.
Can you give us a few clear examples of this niche dominance?
Yeah.
Where do they really own the shelf?
Sure. Look at their market positions. While P&G absolutely dominates the broad laundry category, Arm & Hammer holds a very strong number 2 or 3 position with that impressive 14.8% share we mentioned, driven by value and that tiered innovation.
Okay.
In the cat litter market, they are the undisputed market leader. Brands like Arm & Hammer Clump & Seal, they consistently gain share there through specialized odor control innovation, something cat owners really care about.
Definitely.
And in oral care, thanks largely to the huge success of adding TheraBreath, they've jumped to a strong number 2 position overall in the mouthwash aisle. So you see, they don't have to win the whole store, they just have to own specific profitable shelves.
Right. But even with these carefully constructed moats, they're facing a rapidly accelerating structural headwind that hits their most sensitive spot. That core value business, the Arm & Hammer base. I'm talking about the private label threat.
Yeah, this is arguably the most significant competitive risk they face right now, especially in the U.S. Private label brands, store brands like Costco's Kirkland Signature or Target's Up and Up, they're absolutely surging.
The data shows this clearly.
Oh, the data is alarming if you're a branded player. Private labels are growing at something like 4% to 5% annually right now. That's 4 to 5 times faster than traditional branded goods, which are creeping along at maybe 1% growth overall.
Wow. Why this sudden surge now? What changed in the consumer's mind or wallet?
It's really a perfect storm of 2 major drivers. First, you have sustained, sticky inflation that's driven consumers across basically all income levels to aggressively seek value. They simply have to tighten the household budget somewhere.
Makes sense.
Second, and this is key, the quality perception of private labels has improved dramatically over the last decade or so. They are no longer seen widely as just cheap knockoffs.
True. Some are quite good now.
Exactly. The research actually shows that over half of consumers now explicitly prefer private labels in many categories, citing value, yes, but also recognizing improved quality and performance. They trust them more.
And this directly impacts Church & Dwight because, as you said, something like 36% to 40% of their total portfolio is value-oriented.
Yeah.
The Arm & Hammer household care lineup, the very brands that generate the cash flow, that puts their most crucial segment squarely in the private label crosshairs, doesn't it?
Exactly. The value segments, laundry, baking soda, basic cleaning, are where private label penetration is highest and most difficult to defend against purely on price. If they cannot maintain pricing power and market share here, their cash flow gets eroded, and that M&A flywheel inevitably slows down. It's a direct threat to the model.
So their defense mechanism here is absolutely key. The report identifies what it calls a dual defense strategy against this private label onslaught. Can you detail those 2 prongs for us?
Sure. The first prong is the innovation defense, which we kind of touched on earlier with Arm & Hammer laundry.
Right, the good, better, best.
Exactly. They use continuous product innovation and that tiered pricing model to keep their branded value options competitive and relevant. They try to offer something the private label can't easily replicate, even at the value end. For example, management points out that despite the overall pressure, key brands like Arm & Hammer Litter are actually still gaining share, which they argue proves that innovation can shield even a value-priced product if it meets a real need.
Okay, so innovate to stay ahead. What's the second prong? It sounds almost like an offensive measure.
It kind of is. It's the premium acquisition offense. They are intentionally spending their precious M&A capital, that cash from Arm & Hammer, on premium high-moat categories. Think hero in specialty skincare, TheraBreath and therapeutic oral care, maybe Touchland in premium hand sanitizer.
Why focus M&A there specifically?
Because in those spaces, brand trust, perceived efficacy, maybe even a recommendation from a dentist or dermatologist, are incredibly high barriers to entry for a generic store brand. You are far less likely, as a consumer, to trade down to a store brand for a serious acne treatment or a specific therapeutic mouthwash than you are for, say, generic bleach or laundry detergent.
Good point.
So, in effect, they are using M&A to buy themselves out of the highest risk, most commoditized areas where private label competition is fiercest, shifting the portfolio mix upwards.
Smart. Okay, beyond competition, the broader macroeconomic trends are obviously slowing things down for everyone.
Yeah.
Management has been quite transparent about the consumer slowdown, particularly in the U.S., right?
They have, yeah. They reported significant category consumption deceleration across the board. Growth rates, they said, slowed from around 4.5% in early 2024 down to a much more modest 2% to 2.5% more recently.
That's a big drop.
It is. This generalized tightening across the consumer landscape forced them to revise their full-year organic sales guidance down to the lower end of their initial 4% to 5% range. It shows that when the consumer is really pulling back, even the most defensive categories like consumer staples feel the pinch.
Okay. On a more positive note, though, they seem to have successfully adapted to how consumers shop today, which maybe mitigates some of that pressure on traditional brick-and-mortar sales.
Yeah, that's a definite strength. Their e-commerce execution seems superb, actually. Digital channels now represent a significant 23% of total consumer sales as of Q2 2025.
23%. That's a pretty robust figure for a company with such deep historical ties to physical grocery and drugstores.
It really is. It proves they possess a sophisticated omni-channel strategy. They're capable of reaching the consumer wherever they happen to be shopping, whether that's online, looking for value goods, or browsing premium acquisitions on Amazon or a specialty site. They're meeting the customer where they are.
All right, this brings us inevitably to the financial report card, because this is really where that sky-high 42x premium valuation gets tested day in and day out. And the critical indicator right now seems to be gross margin pressure.
Absolutely. This is the financial battlefield where that private label war and the persistent cost inflation meet the company's balance sheet. After suffering major setbacks due to input cost inflation back in 2022, their gross margin has remained severely pressured. In the most recent quarter, Q2 2025, the reported gross margin fell by a massive 410 basis points.
Okay, let's pause on that 410 basis points figure. Just to remind our listener, a basis point is 0.01%. So 410 basis points is a huge 4.1% drop in gross margin in one quarter. That sounds catastrophic, frankly.
It does sound that way on the surface, yeah.
But we must acknowledge that a large chunk of that was due to some strategic cleanup, correct? It wasn't all underlying weakness.
That's absolutely right, and it's a crucial distinction. The 410 basis point drop was heavily impacted by several one-time non-recurring charges. These were related to the strategic exits from those underperforming businesses we mentioned, Flawless, the Spinbrush electric toothbrushes, and also the Waterpik showerhead business. They're basically clearing the slate, taking the hit now.
Okay.
However, and this is the really crucial signal for investors, even the adjusted gross margin, which strips out those one-time charges to give a clearer picture of the core business, still contracted by 40 basis points in the quarter.
And that adjusted contraction 40 basis points, that's the real problem because it reflects the ongoing fundamental pressure from the market environment, right?
Precisely. That 40 basis point drop, even after adjustments, it's driven by higher underlying manufacturing costs, tariffs still impacting imported goods, and most tellingly, the increased promotional spending they need to deploy to defend market share against that private label threat.
So they're having to spend more to stand still, basically.
In some areas, yes, and that contraction runs directly against their stated long-term goal of expanding gross margin by 25 to 50 basis points annually. That expansion is baked into the Evergreen Model.
Right.
So the current contraction confirms that the cost and competitive environment right now is just too severe for them to achieve the necessary margin expansion that would really help justify that high growth multiple on the stock. It's a key pressure point.
Okay, so margins are under pressure. Now, let's pivot to what seems to be their greatest financial asset.
Yeah.
Cash flow quality. This is the bedrock of the entire M&A model, isn't it?
It absolutely is. Their ability to generate cash is truly exceptional and really distinguishes them from most of their peers, even the larger ones. The key metric here is their 10-year average free cash flow conversion rate. It's 119%.
Wow, 119%. Let's break that down. When we say 119% conversion, that means they consistently convert more than every single dollar of reported net income into actual free cash flow that they can use.
Exactly. For every dollar they report as profit, they actually generate $1.19 in cash. This is a hallmark of excellent working capital management, things like managing inventory and receivables efficiently. They generated a staggering $1.156 billion in cash from operations in 2024 alone.
What's interesting, and maybe counterintuitive for some listeners, is that their cash from operations, or CFO, is consistently higher than their reported net income year after year. Let's just quickly simplify why that difference is actually a good sign for the quality of their earnings.
Yeah, it's a great point. Think of net income as the profit number on your company's income statement, kind of like the headline number. Cash from operations is closer to the actual cash flowing into the company's bank account from its core business activities after accounting for certain non-cash items.
Like depreciation.
Like depreciation, exactly. And crucially for CHD recently, those big impairment charges they took on Flawless or Vitafusion, these charges reduced profitability on paper. They hurt net income, but they don't actually involve sending cash out the door today. The cash was spent years ago when they bought the asset.
Ah, okay.
So when calculating cash from operations, you add those non-cash charges back in because the cash didn't actually leave the building in that period.
So, using the Flawless example again, when they wrote off Flawless, that hammered their net income figure for that period. But because the cash had already been spent years before on that failed acquisition, that non-cash write-off didn't actually reduce their cash generation in that specific quarter.
Exactly right. So when CFO is consistently higher than net income, it signals very high-quality earnings. It means the reported profits are backed up, and then some, by real cash generation. For example, back in 2023, their CFO was $1.03 billion, significantly higher than the reported net income of just $755.6 million. That gap is proof that they are generating massive amounts of spendable cash, which is, as you said, their lifeblood for M&A and everything else.
Okay, so they generate a ton of cash. Let's discuss how management actually uses that enormous pile of cash, their capital allocation philosophy. Is it clear? Oh, it's crystal clear and very disciplined, according to the report and their own communications. They have 3 stated priorities, and they're strictly ranked. Number 1, always, is highly accretive M&A, finding the next hero, or TheraBreath.
Okay.
Number 2 is investing internally in the business. That includes R&D for innovation, marketing to support the brands, and capital expenditures, or CapEx, for manufacturing and infrastructure.
And number 3.
Number 3 is shareholder returns, dividends, and buybacks.
Okay, on that second point, capital expenditures, or CapEx, the report mentioned that these have recently been high, but are thankfully normalizing now.
That's right. CapEx is apparently returning to more historical levels, which for them is typically around 2% of annual sales. This follows a necessary period of elevated spending over the last few years. Since about 2022, they spent approximately $450 million primarily expanding their U.S. manufacturing capacity.
Why the big spend then?
Mainly for laundry detergent, cat litter, and also the vitamins, ensuring they could actually meet the demand, especially after some pandemic-related surges and to support growth. Now that the heavy lifting of that capacity expansion seems to be complete, more cash is theoretically freed up for priority number 1, M&A.
Got it. And finally, shareholder returns. They are pretty much the definition of a reliable, defensive dividend stock, aren't they?
Absolutely. They possess one of the longest and most consistent track records in the entire market. Get this. They have paid a consecutive quarterly dividend for 124 years.
Wow. 124 years.
Yeah, and they've increased that dividend for 29 consecutive years, making them a dividend aristocrat. That includes a 4% increase that was announced for 2025.
Solid.
And beyond dividends, they also manage opportunistic share repurchases. They executed a $300 million buyback program in 2025, for instance. This commitment to shareholder returns really reinforces the defensive nature of the underlying business, even as they pursue that high-growth M&A strategy. It provides a bit of a safety net for investors.
Okay, this brings us back full circle to the central paradox, the conundrum of Church and Dwight. We've just detailed an exemplary cash-rich business with a smart strategy. Now, let's quantify that price tag again because the numbers are stark and, frankly, still a bit dizzying when you look at them.
Yeah, the current valuation is, well, let's just say it's demanding. If you look at their own history, the current price to earnings, or PE ratio, is sitting around 42.2x.
42 times earnings.
Yeah. Now, compare that to their own 10-year historical average PE, which is only about 31.09x. So right now, they are trading at a hefty 36% premium just compared to their own typical pricing over the last decade.
Okay, 36% premium to their own history. But what about when you compare them to the global giants they ostensibly compete against, like P&G or Colgate? The discrepancy there is enormous, right?
It is genuinely alarming, or at least attention-grabbing. CHD's 42x PE is nearly double that of larger, arguably more diversified peers who have far greater scale and, you could argue, stability. Procter & Gamble trades around 23x to 24x earnings. Colgate-Palmolive is also in that 22x to 23x range.
So nearly double.
Nearly double. CHD is being valued by the market almost like a high-flying tech growth company, not a manufacturer of baking soda, cat litter, and mouthwash.
So the big question is why? Why is the market willing to pay this massive premium for what is, at its core, a consumer staples company? What's the narrative the market is buying into that justifies paying twice the price of P&G per dollar of earnings?
Well, the dominant narrative, the justification for the premium, is that the market is fundamentally valuing Church & Dwight not as a traditional consumer staples company, but as that serial acquirer platform we keep talking about.
Okay.
That premium reflects profound confidence, maybe even overconfidence in their M&A execution. It's the belief that management can consistently find, integrate, and scale those high-growth niche brands like Hero and TheraBreath faster and more profitably than anyone else can. They're essentially being priced on the future certainty of delivering that 8% EPS growth target year after year, primarily fueled by M&A.
But I have to challenge that thesis a bit. We just spent time detailing the flawless failure and this significant V-diffusion impairment write-offs from just a couple of years ago, 2022.
Yeah.
That premium valuation feels like it's completely ignoring their history of sometimes quite costly missteps, doesn't it?
That's the absolute core risk right there. You've nailed it. This extreme confidence baked into the price creates basically zero margin for error. The stock becomes highly sensitive, almost hypersensitive, to any perceived misstep in that M&A strategy.
For instance?
For instance, if they are seen to have overpaid for Touchland, or if the integration proves slower or more difficult than expected, or maybe if they just have a prolonged period without announcing the next big accretive deal, the market could punish them immediately and severely.
And that leads directly to the primary danger for anyone holding the stock at these levels, the risk of multiple compression. Can you explain what that means in simple terms?
Sure, multiple compression basically means the stock price falls rapidly, not necessarily because the core business suddenly collapses or sales fall off a cliff, but because the market simply loses confidence in the story or the future growth prospects that justified the high PE multiple in the first place.
So the PE ratio itself shrinks.
Exactly. If growth expectations get disappointed, say, they miss that 8% EPS goal for a year or two, or maybe the gross margin continues to shrink instead of expand, the PE ratio could swiftly drop from that lofty 42x back towards their historical average of, say, 31x, or maybe even closer to their peers down around 25x.
And that would hurt the stock price badly.
Oh, yeah. That kind of valuation drop results in a significant and rapid decline in the stock price, even if the company's underlying sales and profits are still okay, just not growing as fast as expected. It's the classic risk of paying a Ferrari price for what might turn out to be just a very reliable but not exotic pickup truck.
Okay. And finally, the intrinsic value check. The report presumably did some kind of discounted cash flow analysis, or DCF, to estimate what the company might actually be worth based on its future cash flows. Where does that kind of analysis land us?
Right. The DCF assessment referenced in the research, which uses what seem like realistic Evergreen Model growth targets and appropriate discount rates, strongly suggests that the company's intrinsic value range is, well, comfortably below the current stock price.
So math says it's expensive.
Pretty much. That mathematically reinforces the conclusion that the stock is currently fully valued, maybe even overvalued, and the current price is reliant almost entirely on flawlessly executing the next 5, maybe even 10 years of acquisitions and integrations. It's priced for perfection.
Okay, let's spend a bit more time detailing the specific risks that could potentially trigger that painful multiple compression we just talked about. The most immediate and tangible internal risk seems to be the upcoming CEO transition.
That's definitely a material change, yeah. Matthew Farrell, who's been the CEO, really the architect of this successful M&A strategy during a period where the company's market capitalization more than doubled. He's set to retire. And Rick Dierker is scheduled to step into the CEO role effective March 31st, 2025.
The market is always nervous,
Mm.
understandably, when the face of a successful strategy changes. What specific uncertainty does this transition introduce for Church & Dwight?
Well, it primarily introduces strategic uncertainty. Mr. Farrell was clearly the driving force behind the discipline, the philosophy, the execution of the M&A model that the market loves so much.
Right.
Now, the company does have mitigating factors. Mr. Dierker is a seasoned internal candidate. He was the CFO, part of the leadership team implementing the strategy. And Mr. Farrell will remain as chairman for a transition period, which should help.
But the risk remains.
The risk remains that future capital allocating priorities could subtly shift under new leadership. Will Mr. Dierker have exactly the same risk appetite for M&A? Will he maintain the fierce discipline required to walk away from deals that aren't quite right, or to secure these high-return acquisitions at reasonable prices? The market will be watching his first few months, his first communications, extremely closely for any signals of change.
Okay, CEO transition risk. And we must also reiterate the inherent M&A and impairment risks. The M&A flywheel is their greatest strength, as we've said, but it's also its own built-in perpetual weakness or risk factor.
Absolutely. The success of the entire model, the justification for the premium valuation, is contingent on them avoiding big mistakes in M&A. Past events that flawless write-off, the Vitafusion impairment, clearly demonstrate the real financial danger of overpaying for an acquisition or simply misjudging a consumer trend.
And that Touchland price tag looms large there.
It does. The price tag for that Touchland deal is $700 million plus potential earnouts. If that doesn't deliver high accretive returns fairly quickly, the market will question the entire platform thesis, and that 42x multiple could look very shaky indeed.
Furthermore, the research specifically flags that some existing assets acquired in the past are still carrying some risk on the balance sheet, even after previous write-downs.
That's right. While they took significant impairment charges on Vitafusion back in 2022, the report notes that the carrying values, basically the value on the books of both the Vitafusion and the Waterpik trade names, remain at risk for future impairment.
Why?
Well, if their underlying cash flows deteriorate further, perhaps as consumers continue to move away from some specialized health items they bought heavily during the pandemic, or if competition intensifies further, they might have to write down the value of those brands again, which would hit earnings.
Okay, so we have internal strategic risk from the CEO change, inherent M&A execution risk, and lingering impairment risk. So let's just quickly summarize those critical external consumer and financial risks we covered earlier that are pressuring the business right now.
Sure, we really face a dual threat driven by the sustained consumer spending downturn. On one hand, it pressures demand for their premium acquired products like Hero or TheraBreath. Maybe people trade down or buy less often.
Right.
On the other hand, it intensely heightens the competition from private labels for their core value portfolio, like Arm & Hammer laundry and baking soda. Consumers are actively looking for savings there.
And at the same time,
You have persistent input cost inflation ingredients, packaging, transport, plus ongoing tariffs that continue to squeeze profitability, making that crucial gross margin expansion goal, which is really necessary to justify the stock price, incredibly difficult to achieve in the near term. It's pressure from all sides.
And when we look ahead at the company's own guidance for the full year 2025, the outlook seems to reflect this difficult operating environment, doesn't it? It's not exactly painting a rosy picture.
It really does not. Management is guiding for a very flat year overall, which clearly reflects the lack of momentum they're seeing from this difficult environment. They're projecting organic sales growth of just 0% to 2%.
Flat to barely growing.
Exactly. And equally low earnings per share growth, also guided at 0% to 2% growth for the full year. This is the reality of a company navigating some severe macro and competitive pressures, and it stands in pretty sharp contrast to the price the stock is currently demanding in the market. Hashtag outro.
Okay, this has been an incredibly detailed deep dive. If we try to synthesize everything we've discussed, the picture is really quite complex, isn't it? Church & Dwight is, by most accounts, an excellent cash-rich business. It has a proven, battle-tested M&A blueprint that has historically delivered superior growth compared to its peers.
No doubt about the quality of the operation.
But its stock is trading at what the report calls a full price, maybe even more than full. a price that demands near-flawless execution and significant margin expansion, all happening in the face of intense competitive pressure and ongoing cost headwinds.
Yeah, the core conflict is undeniably clear now. You are essentially paying a growth multiple that, as we said, exceeds even some high-tech valuations, but you're paying it for a defensive yet currently slowing consumer staples company. That creates a very challenging risk-reward profile at the current moment.
So for you, the listener, trying to make sense of this, what are the, say, 3 critical factors that you should be monitoring closely over the next 12 to 18 months to reassess this company's trajectory and whether that premium is justified?
Okay, 3 key things to watch. First, definitely listen closely to the strategic priorities articulated by the incoming CEO, Rick Dierker, probably in early 2025. Will he emphatically recommit to the fierce discipline of the established Evergreen Model? Or will he perhaps signal new areas of focus, maybe larger deals or different types of deals that could subtly change the risk profile? His first year is critical.
Okay, watch the new CEO's signals. What's number 2?
Second, watch the integration and, more importantly, the initial performance of the newly acquired Touchland brand. That is the most immediate multi-hundred-million-dollar test case of the refined M&A playbook. Is it delivering the growth and margins they projected? That will be a huge tell.
Makes sense. And the third factor, perhaps the most tangible financial indicator to track.
The third, and maybe the most crucial, is the trajectory of the company's gross margins, specifically the adjusted gross margin.
Right.
That is the clearest, most measurable signal of their success or failure in navigating inflation, fending off that relentless private label threat, and resuming their journey toward improving overall profitability. If that margin stabilizes and then starts to consistently expand again, maybe by that target of 25 to 50 basis points per year, it fundamentally changes the valuation argument in their favor and could start to justify the premium again. If it stays flat or shrinks, watch out.
Okay, CEO, Touchland, and gross margins. Got it. That brings us to our final provocative thought to perhaps send you off with today. We noted earlier that the company's current operational value is built heavily, 75%, on its concentrated portfolio of power brands. But the true market value and the deep consumer loyalty associated with heritage giants like Arm and Hammer, brands that have been trusted for generations, that's likely worth far more than what is currently recognized on the balance sheet as a simple intangible asset under standard accounting rules.
Right, accounting struggles with brand value.
Exactly. So when you see that stock trading at a 42x PE, a price that seems to imply future perfection, the question is, what hidden, unrecognized brand equity, or maybe operational efficiency, is the market already pricing in that the traditional accounting methods haven't fully captured? Is part of that premium perhaps justified by a hidden asset, that brand loyalty, that only the collective wisdom or maybe folly of the market can truly value?
That's a fascinating point to end on, because that brand equity, especially for something like Arm and Hammer, is arguably the ultimate, most defensible competitive moat in the entire consumer staples world. If they truly own the mental shelf space in the consumer's mind, maybe they really do own the future cash flows that justify a higher price. Something to think about.
Indeed. Well, we've covered everything from the good, better, best strategy in your laundry room to the enormous $700 million wager on colorful hand sanitizer. Thank you for diving deep with us today on Church and Dwight.
My pleasure. Thanks for having me.
We'll catch you on the next deep dive.